When you look at what Bitcoin is versus XRP, you'll see for actual usage of the technology, when you pull it up and you compare the two against each other, here's what you'd come up.
Bitcoin still holds the crown, but the conversation is changing. For over a decade, it's been the undisputed king of crypto, but now another contender is quietly proving it can move money across the world in seconds, for a fraction of a cent, and with barely any energy use. That contender is XRP. This isn't about taking sides, it's about understanding why these two giants represent completely different visions for the future of finance. We'll explore the cracks appearing in Bitcoin's armor, why speed and scalability matter more than ever, and how XRP's approach could reshape what we expect from digital money. By the end, you'll have a clear picture of the strengths of both. Seriously, try to pay for your coffee with Bitcoin, and you might finish your workday before the transaction clears. The network maxes out at roughly 7 transactions per second on a good day, and the average 10-minute confirmation time is more of a suggestion. Tired of waiting forever? Sure, you can pay extra to skip the line, but that express lane can cost anywhere from 50 cents to $50, depending on how clogged the network is. And even then, it still feels like you're crawling through traffic. Now picture XRP. It finalizes transactions in a jaw-dropping 3 to 5 seconds, routinely handling 1,500 transactions per second. The fee? A microscopic fraction of a penny. That's not just faster, it's a completely different league. Imagine sending $1,000 to Tokyo. With Bitcoin, you click send, make a sandwich, and still see that infuriating unconfirmed label. With XRP, the money arrives before you can open the mayo jar. This isn't just about personal convenience, it's about institutions that operate on razor-thin margins where every second counts. For them, 4 seconds versus 10 minutes is an existential difference that impacts their bottom line, compliance, and ability to function in a global economy. Let's talk about Bitcoin's energy habit, because it's a big one. The network chews through as much electricity as the entire country of Argentina. And just one Bitcoin transaction, it can use about as much power as the average American home does in a whole month. This tangible environmental footprint is a direct result of its proof-of-work mechanism, a global computational arms race where miners expend massive energy to solve cryptographic puzzles. It's secure, yes, but inherently and astonishingly energy-intensive. Contrast that with XRP. Its consensus algorithm requires no miners and no trillion hash lottery. The Ripple protocol consensus algorithm uses a network of trusted validators to agree on transaction validity. It's a lean, mean, transaction-confirming machine. The entire XRP network could run on the power it takes to operate just a handful of gas stations. Regulators in Brussels and Washington are sharpening their carbon sticks, and every kilowatt Bitcoin consumes is a liability. Banks see Bitcoin's colossal carbon footprint and quietly shred the memo. But when they look at XRP's minimal energy usage, they sign pilot programs. Bitcoin's security is paid in megawatts, XRP's is paid in goodwill from sustainability officers. Bitcoin's pitch is elegantly minimalist: 21 million coins, period. Buy it, hold it, and hope someone pays more later. It's digital gold, a hedge against inflation, a decentralized asset designed to sit, appreciate, and be scarce. Its core design prioritizes censorship resistance and long-term value preservation, making it attractive as a revolutionary alternative to traditional finance. XRP, on the other hand, was pre-mined with 100 billion tokens released from escrow on a predictable schedule. Its goal was never to be digital gold. From day one, it was designed to be the fastest, most efficient way to move euros, pesos, and yen across borders without freezing trillions in dusty old correspondent banking accounts. XRP aims to dissolve that dead capital by acting as a real-time, on-demand liquidity solution. The result? Bitcoin wants to sit in your cold wallet like a fine wine. XRP wants to move, to bridge, to facilitate. One is a digital bunker, the other is a bullet train. When central banks evaluate tech for central bank digital currencies, their questions are about speed and settlement. Bitcoin is rarely invited to that meeting. XRP is consistently at the table. Bitcoin boasts thousands of nodes and no CEO, which for many is the holy grail of censorship resistance. It's a network where no single entity can dictate terms, halt transactions, or seize funds. This permissionless nature is a core tenet of its anti-establishment ethos. XRP, however, has a default unique node list partially curated by Ripple. Critics pounce on this, calling it a centralized bankster coin vulnerable to control. Supporters counter that anyone can run a validator and change their UNL, and the network will still reach consensus. Here's the uncomfortable truth, often lost in the shouting match. Most retail users don't care about node count. They care if their money arrives fast and cheap. Institutions care even less about theoretical decentralization. They care about legal indemnity, audit trails, and having a phone number to call when things go wrong. Bitcoin offers permissionlessness, but often at the cost of speed. XRP offers speed and cost efficiency, but at the cost of some measure of that permissionlessness. Market history shows the crowd votes with convenience first and ideology second. Bitcoin's tokenomics are tied to mining. Miners must cover massive electricity and hardware costs, which means freshly minted BTC hits exchanges daily, creating constant sell pressure. The halving event cuts this supply flow every 4 years, historically leading to price pops. It's a clever mechanism for scarcity, but also an economic tightrope walk for miners. XRP's supply of 100 billion tokens was pre-mined. Ripple releases 1 billion XRP monthly from escrow, but sends most of it back, transparently managing the circulating supply like a central bank. Critics scream dump risk, but institutional finance sees predictability. Banks and treasury departments love knowing exactly how many coins will exist next quarter when modeling liquidity. Furthermore, the lack of mining means XRP never faces a hash rate death spiral. If XRP's price crashes, validators keep validating because their costs are minimal. Bitcoin's security, however, is directly tied to its price. If the block reward can't pay miners, they shut down, the hash rate drops, and the network becomes less secure. This is why some Bitcoin core developers have privately discussed the heresy of hiking the 21 million cap, a move that would shatter its core narrative. Bitcoin's path into the financial mainstream was paved by ETFs. When the SEC finally approved spot Bitcoin ETFs, billions of dollars from pension funds, hedge funds, and everyday investors poured in almost overnight. It wasn't just a financial product, it was Wall Street's official seal of approval. XRP's journey has been slower and messier. After a long legal battle with the SEC, Ripple now has regulatory clarity, and the agency recently announced it will drop its cross-appeal. That single decision cleared one of the last major clouds hanging over XRP's status. Now, the spotlight is shifting. In September 2025, the SEC approved new generic listing standards that allow exchanges like Nasdaq and NYSE to launch spot crypto ETFs without going through lengthy case-by-case reviews. This change cuts approval times from 240 days to as little as 75. And opens the door for ETFs tied to digital assets beyond Bitcoin and Ethereum. Asset managers are already lining up. Grayscale, Bitwise, 21 Shares, and others have filed for spot XRP ETFs under the new framework. Ripple's CEO Brad Garlinghouse has gone on record saying he expects approvals as early as late 2025, and prediction markets now give XRP ETFs a high chance of landing before year's end. Why does this matter? Because ETFs aren't just about price, They're about access. They allow institutions that legally can't hold crypto directly to get exposure in a fully regulated wrapper. Bitcoin needed Wall Street to build that bridge before it could go mainstream. XRP might soon get the same bridge, with a much faster and cheaper network underneath. If that happens, it could fundamentally change how liquidity flows into the asset, not just in the US, but across emerging markets where ETFs can become the easiest way to tap into the crypto economy. Bitcoin's scripting language is intentionally limited for security and simplicity. This means significant innovation must happen on layers built on top of Bitcoin, like the Lightning Network. It's a modular approach that adds complexity and requires specialized knowledge. The XRPL, by contrast, comes packed with powerful features out of the box: on-ledger escrows, payment channels, a decentralized exchange, and native NFT capabilities. Builders can issue fiat-backed stablecoins in minutes, a feature that has quietly turned the XRPL into the backbone for several CBDC pilots. While developers on Bitcoin fight to squeeze ordinals into tiny blocks, an XRPL stablecoin moves millions for a fraction of a penny seamlessly. Bitcoin may have more GitHub stars from its long history, but the XRPL is seeing a surge in fintech-specific development. When fintechs pick a blockchain, they ask, can your base layer handle compliance logic and issue regulated assets? XRPL nods enthusiastically. Bitcoin shrugs and points to a Layer 3 solution. Bitcoin enjoys the fame of the Lindy effect. The longer something exists, the longer it's likely to continue existing. This longevity has given Bitcoin a priceless brand as the original pioneer, instilling confidence in its future survival. Yet brands erode when utility gaps become impossible to ignore. Remember Kodak? They dominated photography until digital cameras made film obsolete. Nokia ruled mobile phones until smartphones offered a different level of utility. Bitcoin's brand is digital gold, but even physical gold has industrial uses. Bitcoin, comparatively, has memes, ETFs, and laser eyes. If the actual movement of value migrates to faster, cheaper rails, then Bitcoin's only remaining moat is collective belief. And belief, while powerful, is fragile. XRP doesn't need to kill Bitcoin. It only needs to capture a slice of that real-world use cases that Bitcoin's narrative shifts from currency of the future to collectible of the past. Bitcoin's network effect is robust, built on millions of retail and $1 trillion derivatives market. Its infrastructure of exchanges and custodians is vast and mature, reinforcing its dominant position. XRP's network effect operates differently, but is equally potent in its niche. It's driven by payment providers like Santander, SBI, and PayPal, which move billions of dollars through remittance corridors from places like Dubai to Manila. Every new corridor that integrates with the XRPL increases demand for XRP, as treasury teams buy, bridge value, and sell it within seconds. It's a quiet flywheel, but incredibly sticky. Bitcoin could theoretically replicate this with the Lightning Network, but Lightning comes with its own complexities: inbound liquidity, channel management, and watchtowers. CFOs don't want those on their risk disclosures. They want simplicity and reliability. XRP's network effect is profoundly impactful where it matters most, in the actual flow of global capital. If you're still on the fence, drop a comment right now. Are you Team Bitcoin or Team XRP? And smash that subscribe button so you don't miss out on any future projects. It's not one number that keeps Bitcoin purists awake. It's the combination of small advantages stacking up into something that feels impossible to ignore. Start with speed. XRP moves value across the world in about 4 seconds. Bitcoin? You're waiting an average of 10 minutes for confirmation, and that's if the network isn't busy. Then there's scale. XRP's base layer can handle around 1,500 transactions per second, while Bitcoin tops out at about 7. One feels ready for global payments, the other feels like dial-up internet. Energy is another sore spot. XRP's transactions sip power, measured in kilojoules, while Bitcoin still burns through kilowatt hours, making sustainability a feature for one chain and a headache for the other. XRP has fought its battles and largely won, giving it clarity that doesn't depend on Wall Street lobbying for ETFs. Its supply is released in predictable monthly escrow, while Bitcoin's halvings create volatile cycles of feast and famine. And while Bitcoin takes years to expand its use cases, XRP payment corridors are going live in months. Put all of that together, and Bitcoin's fortress starts to look more like a single-lane bridge with too many toll booths. The fear isn't that Bitcoin disappears, it's that it becomes a niche asset, more like a digital Swiss bank account, secure but slow and expensive. Meanwhile, XRP quietly turns into the next generation SWIFT. Once investors make that mental shift, the money starts moving. Bitcoin maximalists call XRP a centralized bankster coin. XRP advocates call Bitcoin boomer gold. The insults obscure a fundamental truth. Both chains can coexist, but coexistence is not parity. Bitcoin wants to be the base layer of a new financial order. XRP wants to be the frictionless plumbing that order flows through. These goals clash when investors allocate capital. The market is a voting machine in the short term, but a weighing machine in the long term. And when it comes to weighing, speed, cost, and eco-compliance matter more than ideological purity. When a bank needs to move billions across continents, practical realities trump abstract ideals. Every new climate regulation and ESG mandate tightens the screws on proof of work and quietly advantages XRP. Bitcoin's tribal shield is strong, but policymakers don't hodl culture. They hodl mandates, and those mandates are aligning with XRP's strengths. Imagine it's 2026 and you see the headline, World Bank pilots XRPL for remittances in 40 developing nations. That's not science fiction, it's a very real possibility. If that happens, XRP's volume could triple, its price could shoot up, and the media would completely change its tune. Meanwhile, nothing about Bitcoin's code has changed, but suddenly it's no longer the center of attention. That's how tech shifts always work. Mainframes didn't disappear overnight, but PCs became the default. Dial-up didn't die instantly, but broadband made it irrelevant. Bitcoin will still be around, it might even become more respected, but it could turn into the expensive, slow collector's item of crypto, while faster, cheaper networks quietly move most of the world's money. Bitcoin is still the digital Fort Knox, solid, respected, but undeniably slow. XRP is the armored hovercraft, fast, efficient, and built for today's world. Kings don't usually lose their crowns in one dramatic moment. They fade, one convenience at a time. That's the quiet fear behind every hash rate dip when a payment processor chooses XRPL instead. The war isn't just ideological, it's technological. And right now, speed, efficiency, and sustainability are winning. Fort Knox still stands, but the hovercraft is circling closer every day. So which side are you riding with? The fortress or the hovercraft? Drop a comment below, hit subscribe for the data that keeps you ahead of the curve, and I'll see you in the next deep dive.